Welcome to episode 80 of Accessible Finance. I'm Eric Johns.
And I'm Rachel John.
Let's dive in.
All right, Eric. So what is your favorite phrase on this podcast?
Let's dive in.
No. You say it more
Roth
than...
conversions.
Well, okay, fair. Second favorite. It starts with it.
It is go time?
It depends.
It depends.
It depends.
Okay. Well, I should say that more than I feel like I do.
I feel like you say it an appropriate amount.
Right.
Okay, so
Good.
we have a number of rapid fire questions that are going to tell you cannot reply with it depends.
Okay. If that's the case, then this is in no way financial advice or cannot be construed in any way.
The disclaimer here
advice.
Is that in reality, it certainly depends. But
Yes.
What we want to know is if not all of these are yes or no questions, but if it is a yes or no question, we want to know more often than not what tends to be the appropriate answer.
Okay.
Okay.
These games are very fun. They're very difficult because it does depend. Rachel?
No, I know. But they're
All
rapid
right.
fire.
I understand.
Okay. I will let you it depend caveat after
It's
your
not,
answer.
Sure, but it's not entertaining to just hear it depends on a bunch of questions that people want hard answers to. I understand that.
So we're going with
I will try.
More often than not.
Okay.
What, at least in your experience, more often than not, what tends to be the correct answer.
I haven't read these questions, by the way, so this is going to be interesting.
Them at all. Okay. The first, not all of them are yes or no's, though.
I'm with you.
Okay.
Let's go. Hit me with them.
All right. So the first one, what is the biggest mistake people make in the 5 years before retirement?
5 years. I think the biggest mistake overall is not retiring to something and retiring from something. And kind of assuming that the second that you stop work, everything's going to be, unicorns and rainbows and just the best time of your life. And I don't know that that's always the case if you haven't really thought through what that even looks like for you,
Yeah.
So succinctly, I would say not having social groups and the social interactions, particularly for men, when you retire from the workplace. Females typically have more meaningful relationships throughout their life that are not their spouse. Males typically talk to the people at work because it's convenient and we're, Hulk smash type people. So
You certainly are. Yeah,
that's true.
That's fair. I would say that the biggest mistake people make in the 5 years before retirement is not thinking about retirement.
Sure. Yeah.
Right?
Okay.
Like not planning.
Right. Or
for
pulling
it.
the trigger too early. There are a number, right? But I think the largest portion of the largest contributor to the unhappiness is the lack of social interactions, even if you are financially, ready.
Savvy and ready. Yeah. That's a good one. Look at you.
I'm incredible. That's a great point.
He's growing, guys.
Really good point.
He's growing. Okay. Rapid fire question number 2. Should I pay off my mortgage before I retire?
I can't say it depends, so I will say
more often than not, yes or no.
More often than not, if you're not paying off your mortgage, you should have a great reason for not doing so, and you should be financially able to do so. Does that make sense? So if my mortgage is $300,000, if I don't have over $300,000, I should not retire. Like if I can't liquidate $300,000 in a reasonable time frame.
So it should be a conscientious choice you're making for a reason, not not paying it off out of necessity.
Correct. I can construct scenarios where your mortgage is at a low rate and you have a significant tax deferred balance, so you don't want to rip all that out and pay the mortgage off because then you'd incur a larger tax bill than you would over time. And as we always say, your marginal effective tax rate would go up higher than it would spike higher than it would in the future. You want that to be relatively flat.
Imagine if your current investments are yielding a greater growth than your
if the market's depressed, sure, yeah, that's true, right? So if you have a lower mortgage rate, but more than that, I think if the market's in a really down cycle, you don't really want to rip the funds out.
So there are a number of scenarios where the answer would be no.
But I think you should absolutely have the funds available to do so, and you should have a very deliberate the decision should be deliberate and very well thought out.
I like that. Well done.
Thank you.
All right. Rapid fire, which means rapid answer.
Okay.
What's the difference between a Roth IRA and traditional IRA?
Roth IRAs grow tax-free after paying taxes. Traditional IRAs are tax-deferred. You pay taxes at an ordinary income rate upon withdrawal. Was that good?
Yes. Rapid fire part B.
Okay.
What one do you like more?
Roth is the best.
I couldn't get away from that.
It's typically great.
It is his favorite.
It's a great tool.
All right. How much should I have saved by age 60?
I have no idea. I don't know what you're spending.
You don't have to give me necessarily a number.
It depends, but it depends only on your spending.
Okay, so I spend X dollars.
And your retirement age. Are you 60 working till 80 or are you 60 retiring next year?
I spend X dollars.
I
Tell
don't
me in
know.
terms of X.
Divided by 0.04 and then retire at 67 on average.
Okay.
Fair?
Yes.
Okay.
Yes.
I doubt anybody's going to really get that and
No,
understand it.
I think that how much should I have by 60 is not going to be a $1 million answer, right?
No, definitely not.
But it's going to be based upon like what you're spending and what your withdrawal rate's going to be.
We've seen people spend $30,000 a year. We've seen people spend $300,000 a year in the first 4 months, right? So
I mean, we've seen people who have
I
millions
guess it's closer to like
who spend
$800K.
$30,000 a year, and we see people who have
Mm-hmm.
$30,000 and are spending
Yeah.
$60,000.
Just assuming that things will work out, right?
Yeah.
Yep.
Yeah. Okay. Is it ever too late to start saving for retirement?
No, obviously not.
Okay.
I mean, if you're retiring tomorrow, you've got nothing. Sure, it's not great.
So then the answer would be yes.
Sure, then I guess you can construe a situation or scenario where yes, it's too late, but it's you.
No.
Yesterday's better than today, but you should always start.
All right. When should I start taking Social Security?
Oh boy, this is a rough stipulation, little constraint here. Again,
you can caveat.
This is
after.
not financial advice.
Answer.
Never financial advice. Typically, want to defer if you plan for longevity. I would defer until 70 and look at it not so much as I'm maximizing my income, but that I'm insuring against or hedging against longevity. Does that make sense? So I'm gaining the 8% in the years between 67 and 70. And then it's going to be a COLA adjusted or cost of living adjustment. It has COLA adjustment. So it's going to be inflation adjusted income stream. That is something that I think people really enjoy. I think income in general is maybe like overvalued by retirees. There's something safe about like an annuity stream.
Getting your thing,
or in this case, an annuity stream is just usually going to be a fixed dollar amount how much you want to pay for the income rider. I mean, the inflation rider. But Social Security is going to be cost of living adjusted. So it's quite good.
At least for as long as it
usually
exists.
Defer.
All right. What is the best way to reduce taxes in retirement? You can talk about it.
Roth conversions. You should do a Roth conversion ladder. Usually, it depends, right? Obviously, it depends. If you have a bunch of deferred comp that's going to hit you in the years right after you retire because you planned well.
I can feel your anxiety coming over.
I know. I'm sorry.
I know. It's stressing you out.
I'm sorry. But the idea is it's typically advantageous to do a Roth conversion ladder so that you're not letting RMDs dictate your tax brackets. Does that make sense?
Well, and like we talked about in our last episode, oftentimes the largest investments that people have are in their deferred accounts. They're in their 401ks.
Yeah.
And so
it's almost always the largest.
Yeah.
And it's sometimes north of 90% the largest, right? They might have like
hugely the
few 10 or 20,000, 30,000 in a brokerage account or checking plus savings. And then almost no Roth account and almost everything is in
I would say the majority,
deferred.
we tend to see like massive 401ks. And then we have your house. And then we have
right.
For way further down something. I mean,
I was thinking liquid, but the housing is obviously
no, but I think it's important to note
even
that
with
like
the housing plus
it's still
non 401ks
much
is
larger,
still 20-30%.
Correct.
So still north of 70.
Yeah, I mean, it's big, and so if your RMDs are sitting there being like, surprise, you get to pay X amount of tax, like being able to do Roth conversions and reduce what those RMDs are later.
Yep.
Are huge.
I think the biggest thing that if listeners take away nothing else from this podcast in general, I would say that it's be intentional about when you're paying taxes and the realization of income to the extent that you can, right? So we want to be absolutely sure that we have a plan for what we're getting, when we're going to get it, and how that's going to impact our tax situation. Like we don't want to be just, you do not want to be reactive when it comes to tax planning. You want to be proactive and you want to be looking forward rather than just today, where you hand a pile of papers to your CPA and say, oh, what do I owe?
Yeah.
That's
you know what it reminds me of?
Play.
Okay. So there are these games. I'm horrible at video games. I'm a fan.
Pretty good.
No, I'm a fan of them.
Oh.
I enjoy them.
She's good.
Think I started playing video games when we met for the first time ever. But, which granted, I guess was a while ago, but
it's Command and Conquer Generals. No, first
Red
it was
Alert.
Red Alert. It was Red Alert. That's right. Generals wasn't even around.
No, it was
I wasn't playing Generals games at Dibs with my high school friends.
Yeah. No, but okay. So it reminds me of those games where Mario might have something like this where like there's spikes on the top and spikes on the bottom, and you have to like fly and stay right in this little happy zone, right? And you go too high.
Yeah.
So like every time you talk about taxes and stuff and doing that, it reminds me of that, because you want to be able to be consciously playing this game where you're staying there, where you're not dipping into the like 10 or 0% bracket, but you're not blowing yourself up and unintentionally going up.
A fantastic visual.
Thank you.
We should absolutely create that and hand it to, individuals, clients, everybody that we're trying to educate, right? So that's
how I envision
really
it. And it's a really tricky and stressful game for me. I don't like it at all. But
wait, the Mario or the taxes?
The Mario.
Okay.
It's stressful for me because I'm like, oh my God, I'm going to pop. It is stressful. And the taxes situation can feel that way. The idea is to find somebody who loves it.
I was going to say, I like taxes more than Mario. I don't like Mario.
If you find
Mario
someone,
Kart, that's a different story. Mario Kart's a great game.
There's a new one, Mario Universe.
No, but people love regular Mario though. I just was never really that good at it, so I can't.
It's hard. It stresses me out because I know I'm either gonna I am a very reactionary video game player.
Yeah.
So like I'm the person playing Mario Kart that does this with the controller. So like when I'm playing regular Mario, if I go up a little too much, I'm gonna overcorrect every time, and so I end up, dying. But you don't want to feel that way. You don't want to feel that anxiety with your tax brackets. You don't want to feel like you have to overcorrect because last year, I took out too much. So now this year I'm going to take none out. Like there is a very mathematical way to calculate all of this stuff out. And if you find the right person or the right tools, it can be a really, really easy game that you can play and win at. And I think it's one of the only, and we talked to our clients about this. We can't predict what the market's going to do.
Correct.
We can make best decisions with the information that we have, but we know exactly how to prepare for taxes.
Yep.
It's not a guessing game. We know where the spikes are at the top. We know where the spikes are at the bottom. We know how to stay in the little happy zone.
That is right.
So yeah. Thank you.
I'm looking forward to the visual.
I'm on it. All right. So next thing.
We're relying on you for pacing, by the way. I have no clue how many questions are.
I'm going to ask you 80 million.
I mean, they're right there, but I haven't read them. I'm not sure.
You're not going to read them.
All right. Proceed.
It's more fun this way. Okay. My apologies. All right. How do I estimate my healthcare costs in retirement?
Ooh.
Tricky.
There is there's a Medicare bracket, and then you can look at your tax brackets for your IRMA, and you can assume Medigap coverage and go look at, what is it, Plan G, I believe it is. They retired. What is it, F? Sorry, but there's various forms of Medicare, and then you can have Part D prescription coverage. So Medicare Part D coverage is also going to be offered by a private insurer. So when you're going above and beyond the standard provisions of Medicare, there's going to be Medicare Part A, which is the hospitalization, and then Part B is going to be your what you think of normal, like your clinical visits and short stays in like nursing homes following hospital care, that kind of thing. That will have like Medigap coverage, which is supplemental coverage, so that you're not just paying 20% of all the expenses. Sorry, I don't want to go too far in the weeds, but
you're fine.
But essentially, you can look at your expected modified adjusted gross income for IRMA purposes, which is the Medicare adjustment amount, the additional premiums you have to pay over I think it's like $175 ballpark a year if you had like low income. You'll have to, there's about $100 extra per jump. So you want to look at that. You can quantify that, and then you can quantify the cost of the Medigap coverage on a monthly basis. Maybe $100, $200, something in that ballpark, and then the prescription coverage another $100 or so. You can get a pretty decent idea of what healthcare is going to cost. Maybe $6,000 a year, something in that ballpark. If you're going Plan G with prescription coverage.
So that'll cover my healthcare coverage piece. And then what if you're trying to estimate, okay, like what are average like medical expenses?
Well, you're only going to pay the deductible for Medicare. I think it's like $240. Don't hold me to that. But if you had like a Medicare supplement, so like if you're on Medicare supplement Part G, then you're only paying the deductible and then the premiums for Part G, and then the additional premiums, your IRMA premiums, right?
And this is where it's really important to understand the benefit or value in understanding the supplemental coverage if you're looking.
What is the IRMA acronym again? It's like income related monthly adjustment amount or something like that.
But there's two M's. Oh, no, there's 2 A's.
Yeah, I think so.
I think you're right.
This is important, everyone. Income-related monthly adjustment amount.
Look at you.
So good at this.
But again, yeah, so this is where getting that, if you were to go and get the supplemental coverage, it lets you have a far greater idea of what those costs are going to be because you understand kind of like what your ceiling is.
Correct.
Whereas if you're not getting that, it's going to be variant.
And your ceiling's quite low.
very much.
Right. So the tip, right. Yeah. Let's leave it at that. That's good enough, right?
Yeah.
For a rapid fire answer, we could do an episode on it if we want.
He was ready to start a whole episode.
Yeah. Gonna start talking about Medicare Advantage and the differences, but that's rabbit holes.
All right. So Eric, this will help you to elaborate a bit on the earlier question about I'm 60, how much money should I have saved up?
Okay.
What's the 4% rule? And then a caveat to that, does it still work?
Boy, this has been debated heavily in the shout out to Rational Reminder, the Rational Reminder community. There are people that have replicated the study and said that it's less. There's some people that said it's more. There's some people that say that's because American exceptionalism and markets. Number of
reasons.
Yes, but essentially that is, the study was done initially and found that you can be relatively certain. I forgot what the probability of success was, but I believe it was north of 99% probability of success with a 60-40 portfolio over about a 30-year retirement period, starting I think 65 to 95, ending at 95. If you had your assets allocated 60-40 and you withdrew 4% a year in the first year and then adjusted for inflation from that initial number, you would win, or you would
end with
you would not outlive your dollars like 99+% of the time, maybe with 100. It was a substantial, like a relative certainty. Right. So the idea is I can always withdraw 4% when I retire and then just inflation adjust that amount. Does that make sense?
Yes.
So if I can withdraw 100, if 4% of my total is 100K, then I can withdraw 100K my first year and then say inflation's 4%. Now I get 104,000 my second year and so on. So that's the idea. That's the 4% rule that you'll hear a lot of talked about, that you'll hear discussed quite a bit. Some people still use it. It's a decent ballpark estimate. I think that's about as far as I would go with that.
So it's a super oversimplification of reality, right? But it's like a decent proxy for anything else.
Yes.
I mean, like if you aren't working with a planner, if you're not willing to put in the work to look at your specific numbers and your specific situation.
Correct. It's a good idea to you can get in the ballpark, right? Like maybe you divide it by, or you take your spending, you divide it by 0.04 and you get a number like 2 million and your current, liquid assets or current net worth is even like 500,000.
We're not close.
You're not there.
Yeah.
Right. Like
you're not ready to retire.
You can't make the leap yet.
And again, this goes off of the idea of retiring for 30 years, right? So if you're looking to retire earlier, you're looking for a larger number.
Correct. And it's going to interact with Social Security as well, right? Because we said that that's cost of living adjusted. So you're really going to be with the demand on your portfolio is what the 4% is talking about. Does that make sense?
So it's the shortfall.
So if my spending is $100,000 a year, but Social Security from both of us provides us with, let's say, $50,000 a year. Well, then let's say 60, just so the numbers are the same. So our Social Security provides us with $60,000 inflation adjusted. Now I know that my draw on the portfolio only needs to be $40,000. So now I can have $1 million, right? Theoretically with the 4% rule, because I'm saying 4% of $1 million is 40,000. Now we're okay.
Yeah.
Does that make sense? And then I just inflation adjust the 40,000. My Social Security portion is already inflation adjusted. I'll probably be good to go there. That's what the rule is saying. I'm not saying that.
Right. That is your very rugged napkin math.
Yeah, there's a bunch of granularity you can get into on why that study may or may not still work.
Perfect. Thank you.
You're welcome.
Can I work part-time and still collect Social Security?
Can I work part-time and still collect Social Security? It depends on your age, right? So once you get to full retirement age, you will have no reduction in your Social Security benefits from work. If you are below full retirement age, which is 67, if you're not born within like the window when they change the rules, or shortly after they change the rules. Yes, you can work post full retirement age with no reduction. Pre full retirement age, there are caveats, right? So if you earn over, it used to be like 19 and some change. So let's say if you earn over $20,000, then it reduces you by your Social Security by $1 for every $2 you make over that limit. Don't hold me to that, but it's ballpark accurate. Maybe it's $3. I don't know.
So you can look up the limits easily.
But yeah, it starts to phase out, or you start to reduce your Social Security once you start earning over, let's say $20,000 if you're below full retirement age. After full retirement age, you're good to go. Do what you want.
Well done.
Thanks.
How do I avoid running out of money? Spend less.
Use a calculator and do some math. That's pretty funny, right?
I mean, honestly, we imagine it like calories in, calories out, right? Like there's some type of stasis here with funds, right?
Sure.
Like if you're spending more than you are.
Yeah. Just note that the funds are going to go like this because that's what markets do, right? Yeah. They're going to move. They're going to be volatile. There's going to be some variance in the actual account balances. Like if you check it every day, you're probably going to have a bad time, especially if you're an anxious
Honestly,
person.
I think the best way is to like check in. But like Eric was saying, if you're checking in with your plan, like if you're looking daily or hourly at your balances in the market, you're going to drive yourself crazy.
Right. You need to live.
But like monthly check-ins to see like how did I do on my spending this month? How is my like income, right? Or if you're retired, like am I withdrawing in keeping with, the percentages and stuff that have been aligned? If you're totally not sure or if you don't have a budget or anything like that, like it's at least worth looking at like having a firm grasp on what your outflows are.
Right.
Okay. Should I downsize my home or stay put? I'm retired.
You do what you want. It depends. How much extra money do you have? How much happiness are you going to gain from downsizing your home?
I think it's a frequent question where people are like, okay,
what's
like
the opportunity cost?
Kids are out of the house. I don't need a house this big. Like I could retire to a condo. Sure. I could, but downsizing doesn't always mean saving money.
That's also true. I would say, like, what are you going to do with the money, right? Like, maybe I sell a $500,000 house and I go buy a $200,000 condo. I now have $300,000 that I can pocket minus the realtor fees,
closing costs.
Right. Yeah. What am I doing? Moving. Like, what's my goal? Right. Like, do I want to leave it to my kids? Do I want to go tour Europe every year for a month or so?
Right.
Like,
what's the
purpose?
Am I
doing? Yeah. Have a plan. If that works with your plan and you think that's going to increase your happiness more than staying in your $500,000 house, please do.
All right. What's the safest investment for retirees?
Oh, boy, we're already over time, or I could sit here and talk for 30 minutes.
Not over time. We're in time.
Well, I like to keep it brief, Rachel. What?
Okay.
This answer's not going to be brief, that's for sure, huh?
It has to be brief.
What was the question? I forgot.
Safest investment for retirees.
Just kidding. I guess the actual answer is probably an annuity, right? An annuity with an inflation rider. Yes, I would resist the urge to say any kind of fixed income because you will typically get eaten up by inflation, or the TIPS rate of return will be so low that you won't meaningfully impact your actual nest egg.
Love it. Is long-term care insurance worth it?
No. No. Just if you have it already, it used to be better than it is. I've said this before, right? It used to be they actually wrote it too well at the beginning, and they didn't charge enough. So if you're in one of those old school grandfathered in policies, those are probably okay. The newer ones, they've started to realize how much they need to charge you so that they can cover their costs. And that turns out to be a lot higher than they were charging initially. So yeah. Probably not so great this stage.
Mm-hmm. There are other ways to self-insure.
Right. There are also ways you can convert whole life policies into you can convert them into long-term care or whole life with long-term care riders, things like that. Mm-hmm. You can do some creative planning if you already have other insurance products. Yeah. But I would not advocate, typically speaking, all else equal, generally, I would not advocate long-term care unless very specific scenarios arose.
All right, you got 3 more.
Okay.
How do I protect myself from scams targeting retirees?
That's rough.
We were talking about
this. That's really rough.
We're actually probably going to do a podcast specifically about this because there's a whole variety of scams that are out there.
I almost clicked that.
We've seen a lot of them.
I almost clicked that DMV link.
Oh, the text ones. Yeah. No, it's ridiculous.
I saw that, somebody in Louisiana came out and said, be careful, this is bad. But yeah, I was close to, because there's an aversion to doing stuff that's wrong. Yeah. I'm like, I might have actually been.
I was not close to it because I'm smarter than this one.
Well, I was the one driving.
It's very convincing. They do a really good job, and they now have fear tactics built in there.
For one of those toll cameras in Florida, because we drove to Disney last time or whatever. I thought it might have been from that.
I think Mom got one of those too.
Yeah, when we were on the way to Durango for.
It's crazy.
Yep.
But there's a whole bunch of things out there. I think the best thing to do is to not knee-jerk react to anything that happens.
Yeah.
They use a lot of fear tactics there where it's like, if you don't respond timely, if It's a lot of things like that that make you feel like you have to do it.
You know what you can do as
Run
well?
it by somebody.
Yes.
Talk to somebody.
I think you run it by somebody, particularly like your kids, somebody you trust. I also would say add a trusted contact to a lot of your accounts. They'll do that at like most of the custodians these days. I know Schwab does it. We do it with our clients. You want a trusted contact so that if you're doing something that seems somewhat erratic from somebody that's been looking at your money for a while, you know, if they see like a series of, you know, $10,000 withdrawals like back to back to back every week or something, you know, they can call somebody else and be like, hey, is mom okay?
Happening?
You know, is dad okay? Like, or do they intend to do this?
That'll help with identity theft stuff.
He's buying a jet ski. Like, okay, like that's great.
Exactly. But before doing anything with anything, I would find someone you trust.
Yep. Have them take a look.
Yes. Get their thoughts on it.
It can happen to the best of us.
I mean, if Eric had asked me prior to almost clicking on that DMV thing, I would have been able to be like, I got that too.
Yeah. Fair. Well, I didn't click. I did not.
I know. So I said almost. All right. Eric, second to last. What is the best way to leave money to my heirs?
Within a Roth IRA account. Did I win?
You won.
No, that is going to be the best, right? It's tax free to them.
It's a good one.
Or alternatively, if it's in a taxable account and you do not sell it. So like you want to.
Oh, you were close to winning. You were just really close to winning the rapid fire answer.
I'm sorry. It wasn't rapid fire.
No, go. I'm just messing with you.
I was just going to say you can take advantage of the step up in basis from your taxable assets. So tax deferred accounts are probably one of the worst ways. I'm sure I could think of some others that aren't particularly good, but you don't want to gift highly appreciated assets before your death. That's bad. Because if you just wait and because
then they get the step
they're
up.
Gifted at market value, but then the basis is going to transfer. So if I have a really low basis asset, then my kid gets a really low basis asset.
Pay the taxes.
However, if I die, then they're still getting it at the market value, which presumably is not that much later if you're really old. And then this is cheery, right?
Yeah.
And
the way you phrase that.
I know, not great. But
the reality is that
But yeah, take advantage of the full step up in basis or leave tax free in a Roth.
All right. And then last but not least, Eric, how often should I review my retirement plan?
We talked about this. Breakfast, lunch, and dinner. You should look at it constantly.
All day, every day. But again, to be clear,
please,
your retirement plan is not the stock market. So reviewing your retirement plan and looking at your stocks are not the same thing.
Correct. Looking at your plan 3 times a day should show you the same thing 3 times a day.
It should help you to feel more confident about the decisions that you've made.
There will be a level of stability there.
So whether it's you've created one yourself or you're working with somebody, how often should you review it? Or if you're working with someone, how often should they be reviewing it?
I like, so if you're asking me, I like monthly, at least at first, and then quarterly is probably sensible after that. Once you realize everything's good, we're on the rails, we're all set. We want to see kind of what the impacts of, we want to kind of get a sense of the impacts of the volatility in the markets. And that might tell us, hey, we don't have the stomach for this. There's too much volatility. I'm seeing my percentages change too much based on, the market's going down 20% or 14% or whatever. Now it's back. We want to get a sense of that. But once you get a sense of it and you're comfortable with it, then checking every quarter is probably fine.
And this right here goes back to the question of how do I avoid running out of money? Like it's literally just looking at your plan and making adjustments as needed.
Right.
And like Eric was saying, in the beginning of when you're retired, looking monthly is very reasonable because your estimations of what you're going to spend in retirement and the reality of what you're spending in retirement are likely not the same thing. And then adjustments can be made accordiingly.
Right. You have a bunch of free time now.
Yeah. What you doing?
Got to go have fun. Lunch with the friends. Sometimes that costs money.
Sometimes. Only sometimes. Sometimes you're lucky and it's free.
And they pay for it because they're richer than you.
You alternate. All right, Eric, thank you so much for our rapid fire question and answers. You did a really good job.
Fun. I like this.
Again, just to recap, I do too. I'm going to find some more. Again, just to recap, this was in no way financial advice. It was
thank you, Rachel.
Just a more times than not, this tends to be the better option.
Yep.
All right.
Hypothetically speaking, generally educational.
Yes. all the disclaimers.
Yep.
Okay. All right. Well, thank you so much for tuning in. Until next time.
Thanks, guys.